VXUS dominated the one-year race at 34%, but VOE's five-year performance of 66% absolutely crushed VXUS's 47%. Over 5 years, VOE's 66% crushes VXUS's 47%, proving US value's been the smarter play long-term. But here's where it gets interesting. VXUS crushed it with a 34% return this year. International markets finally outshine their US counterparts in a big way. Let's zoom in on this. VOE's 14% return looks decent until you compare it to international stocks. Domestic mid-cap value just couldn't keep pace this year. In plain English, VXUS absolutely smoked VOE in the one-year race, delivering more than double the returns. It's like watching a Formula One car lap a sedan. International markets just dominated domestic value recently. Here's where the story takes a turn. VXUS crushed it with a 59% return over 3 years. International diversification really delivered through those market swings. Let's break this down further. VOE's 39% three-year gain is solid, but it's trailing VXUS by a full 20 points. That's a meaningful gap. But here's where it gets interesting. VOE's 66% five-year return proves value investing works when you're patient. Steady compounding beats chasing short-term hype every time. Now for the real question. VXUS gained 47% over 5 years. Solid performance, but still trailed VOE by 19 points thanks to VOE's long-term consistency advantage. In plain English, VXUS looked unstoppable early on, but VOE's consistent performance ultimately crossed the finish line first. Like a marathon runner who paces themselves, steady wins over time beat early speed. Here's where things get revealing. Raw returns don't tell you how bumpy the ride was. Let's see which fund earned those gains more efficiently. Now let's put this in perspective. VXUS crushed it with a 1.8 Sharpe ratio. Stellar returns without taking on crazy risk for international exposure. But wait, there's more to this story. VOE's 0.7 Sharpe ratio shows decent risk-adjusted returns, but VXUS clearly outperformed it on this metric over the year. In plain English, think of Sharpe ratio like mechanical leverage. It measures how much return you're squeezing out per unit of risk. VXUS delivered over twice the efficiency recently, a serious win. Let's take a closer look. VXUS maintained a 0.9 Sharpe ratio over 3 years. That's solid risk-adjusted returns even through turbulent markets. Now here's where it gets tricky. VOE's Sharpe ratio hit 0.6 over 3 years. Solid risk-adjusted returns, but VXUS still edges it out in efficiency. But that's not the whole picture. VOE's 0.5 Sharpe ratio isn't flashy, but it's consistently beating international funds over the long haul. That's what counts. Let's see how this plays out. VXUS's 0.3 Sharpe ratio over 5 years shows international markets volatility crushed risk-adjusted returns. You're taking massive swings for minimal reward. In plain English, here's your seesaw moment. VXUS dominates short-term efficiency, but stretch to 5 years and VOE suddenly tips the scale. It's all about where you're sitting on that timeline. Now let's connect the dots. When the market turns ugly, downside protection becomes everything. Let's see which fund actually protects your capital when it matters most. But hold on a second. VXUS nailed it with a 2.3 Sortino ratio, earning strong returns while keeping downside risks impressively low over the year. Let's unpack this a bit. Time to make your call. VOE for US or VXUS for international markets? Here's the key takeaway. VOE's Sortino of 0.9 shows decent downside protection, but it's clearly trailing VXUS by a wide margin here. In plain English, the Sortino ratio is your storm shelter. It shows how protected you're when markets turn nasty, and lately, VXUS built you a much stronger shelter than most. But there's a catch. A 14% drop isn't pleasant, but it's far from catastrophic. Most long-term investors can weather that without losing sleep. Let's get into the weeds here. VOE's 18% drawdown cuts 4 points deeper than VXUS. When you're bleeding money, those extra points really hurt your recovery timeline. Now let's shift gears and look at VXUS bounce back from its worst losses in just 24 days. That's remarkably quick healing for international markets after a crash. But here's where it gets interesting. VOE needed 136 days to recover. That's 4.5 months of watching your money just crawl back to zero. In plain English, recovery time's like watching a building crumble and rebuild. VXUS bounced back in under a month, while VOE's 4-month recovery felt like an eternity when you're checking your retirement balance daily. Now let's shift gears and look at that negative 16% worst year. It's painful, sure, but you'll survive it if you've got the discipline to stay invested. Here's where the story takes a turn. VOE's worst year was brutal, a 37% crash that had tested anyone's resolve and seriously damaged your portfolio's long-term health. In plain English, VOE crumbled like a building with a weak foundation, losing over 1/3 of its value in its worst year. VXUS built stronger, lost less than 1/6. Foundation strength matters. Let's zoom in on this. Correlation with the broader market shows us which funds actually hedge your portfolio when things go sideways. Now for the real question, VOE moves closely with the S&P 500 at 0.8 correlation, exactly what you'd expect from a domestic-focused fund. Here's where the story takes a turn. This 0.8 correlation means international stocks don't really diversify your portfolio. They're just riding the same wave as US markets. Here's the scoreboard so far. VXUS crushed short-term returns with 34% win rate and better safety, while VOE took 66% of 5-year battles, but suffered harder crashes and longer recovery times. In plain English, here's the thing about international diversification. VOE and VXUS are like dance partners with the S&P 500, moving together 80% of the time. Geography doesn't guarantee independence. But wait, there's more to this story. Now we're digging deeper. Concentration risk shows us how many companies are really pulling the weight in these funds. Here's the thing though. VOE holds 185 positions, enough stocks to give you conviction on your picks while spreading risk across different sectors effectively. Let's take a closer look. VXUS holds over 8,500 stocks across dozens of countries. That's genuine global diversification working for you. In plain English, VOE's 185 holdings versus VXUS's 8,592 baskets worldwide. That's the egg basket difference here. One's hyper-focused on emerging markets, while the other spreads risk across the entire international landscape. Diversification at vastly different scales. Let's break this down further. More stocks don't guarantee better returns. VXUS spreads wide across international markets, while VOE focuses sharply on mid-cap value opportunities. Dividends aren't just extra cash. They compound over time and soften the blow when markets get choppy. Let's compare the payouts. Here's what really matters. International stocks deliver a solid 3.1% dividend yield. That's meaningful income you're actually getting paid while you wait for growth. Now let's connect the dots. VOE's dividend yield sits at 2.1%, respectable, but it's trailing VXUS by a full percentage point for income-focused investors. In plain English, think of dividend yield like finding couch change under your cushions. VXUS tosses you $3 per 100 yearly, while VOE gives you 2. That extra dollar adds up over time. Let's unpack this a bit. VXUS dividends jumped 11% as international companies recover. That's real money flowing back to shareholders, not just price appreciation. Here's the key takeaway. VOE's 5% dividend growth reflects its conservative nature. Mid-cap value companies growing payouts steadily, not aggressively chasing unsustainable yields. As time passes, dividend growth mirrors salary raises. VXUS delivered 11% over 3 years, while VOE managed only 5. Time favors international funds for future income growth. But there's a catch. Every dollar you lose to fees is a dollar that's not compounding for you. Let's break down the real costs here. Let's get into the weeds here. VXUS keeps costs incredibly low at just 0.05%. That's 5 cents per $100, so nearly everything you earn stays yours. Now for the real question. VOE's expense ratio sits at 0.07%, just 2 basis points higher, but still exceptionally cheap for what you're getting here. In plain English, think of expense ratios as couch change. VXUS costs a nickel per $100, VOE costs 7 cents. Both are so tiny that fees won't tip the scales here. Let's zoom in on this. 2 basis points isn't worth obsessing over. Focus your energy on returns, risk tolerance, and your investment timeline instead. In plain English, the gap between 0.05% and 0.07% fees, that's literally couch change. We're talking a few bucks that won't derail your retirement. Save your energy for the decisions that actually matter. Here's the truth. There's no clear winner here. It all comes down to your timeline and how much risk you can stomach. Let's break this down further. VXUS dominated recently with 34% returns, better risk protection, higher dividends, and truly global diversification across thousands of international stocks. Here's the key takeaway. VOE's 66% 5-year win shows steady compounding works, but you'll weather deeper crashes and longer recovery times along the way. In plain English, think of it like a road trip. VXUS cruises the international route with smoother roads lately, while VOE tackles domestic terrain that's been bumpier recently but delivered over the long haul. Let's dig into the details. Time horizon matters here. VXUS wins short-term across metrics, but VOE's consistency could pay off if you're patient beyond 5 years. Here's where things get revealing. VXUS recovers faster from crashes, while VOE could drop 37%. That's a portfolio-crushing loss demanding serious stomach for volatility. In plain English, here's your investment test. Can you sleep well through a 37% drop in a 4-month recovery? Or do you need VXUS smoother ride? Your gut reaction tells you everything. But wait, there's more to this story. VOE's perfect for long-term value hunters who can weather big crashes, while VXUS offers smoother global exposure with better income. In plain English, VOE's your heavy-duty domestic racer built for rough tracks and endurance, while VXUS is the sleek international speedster with smoother handling for medium circuits. Different race cars for different tracks. Let's take a closer look. Standard legal reminder. Do your own research and consult professionals before investing. Now here's where it gets tricky. Want more battles like this? Hit that subscribe button and you'll get weekly ETF breakdowns with all the real data.